The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president.
This is definitely perverse and unusual and, frankly, unsettling.
A sitting Fed chair threatened with a criminal indictment. It's unlike anything we've ever seen before. We've got Ed Yardeni of Yardeni Research. He's got 40 years of experience under his belt. Plus, he's worked at the Fed and written books about what investors need to know about the Federal Reserve. There's a difference between what makes headlines and what makes money. For investors, how should we think about this development? We also get his perspective on the markets. Did you say S&P 10,000?
The Magnificent Seven, they are magnificent companies, but they're not going to stay magnificent.
Did that feel a little bit like blasphemy? The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Hi, everyone. It's a new episode of In the Money with Amber Kanwar. Before we jump right in, it's the beginning of a new season, and you guys know I love my swag, but I'm running out of ideas. So all this month, we've got a swag competition. Wherever you are listening, comment. If you've got a funny idea for a finance meme you think should be on a mug or a hat, we're going to look at them all. We're going to pick a winner and we'll send it to that winner. And who knows, maybe by then I'll have an online store up and running and we can sell some of it. But I'd love to know you guys are creative and you love finance as much as me. So meme ideas, drop them in the comments wherever you're listening. Today's episode is less of a laughing matter. Over the weekend, we saw an unprecedented comment by a sitting U.S. Fed Chair, Jerome Powell, basically saying he is being threatened by the U.S. government with a criminal indictment. It was a short, sharp rebuke. It was 2 minutes, but I think it's worth everybody listening to. So let's hear what Powell said about the threats that he's receiving.
Good evening. On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned, in part, a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people. Thank you.
So a couple of things stand out. One, we all know that Trump wants lower interest rates. He said it overtly. He has name-called Powell. That's nothing new. The use of the Department of Justice is new and unprecedented. And up until now, Powell has really danced around the pressures that he has faced politically. So the second observation is this is the most direct pushback that he has seen. This is a really dramatic turn of events, but we also need to understand, does this actually affect your investments, the path of interest rates? To do that, we've got Ed Yardeni of Yardeni Research. If you watch any kind of financial media, you've probably seen him. He's on CNBC all the time. He's super thoughtful. I think he's got like 40 years of experience under his belt thinking about the broad markets and what's going to happen. So he tells me what he thinks about this whole Fed issue. And then he talks about why he thinks there's more upside for the markets, but that the source of that upside is going to look very different than it's been for the last couple of years. Let's get into it. Ed Yardeni, thank you so much for joining me on the podcast.
My pleasure.
We are going to get to learn a lot about you over the next half hour, 45 minutes. But one thing people should know about you right away is you're something of a Fed watcher. You used to work at the Fed. You've published a book, Fed Watching for Fun and for Profit. I don't know how fun it feels these days, particularly if you're U.S. Chair Jerome Powell, who over the weekend, put out an astonishing statement explicitly saying we are being threatened and pressured by the U.S. president. Now, we all know that to be true because of things that Trump has said, but Powell has really danced around it. And this time it was very explicit. This was the most direct he's ever hit back. What did you make of that?
Well, I think he's perfectly justified in finally responding to this barrage of attacks from the Trump administration. I can understand his frustration with these attacks. The reality is he'll be off as Fed chair in May. So what's the rush here to push him out and to sully his reputation for no good reason other than politics?
And I was reading some analysis that this could backfire in some way. Yes, he's due to come off as Fed chair, but his term goes to 2028. And this could embolden Powell to stick around and not allow Trump to put on, an additional member of his choosing.
I think it's a very good point. And while everybody's worrying about the independence of the Fed, I think this is actually going to make the Fed more independent. Even if Trump manages to get his choice in as Fed chair, that Fed chair is not going to have a lot of credibility since everybody will view that his pick would be, let's call it Trump dependent, whereas everybody else would be still data dependent and might be willing to dissent much more often than has ever occurred in the past. Powell has done a great job of maintaining a consensus at the Fed. I think the new Fed chair, to the extent that he's, let's put it bluntly, tainted by politics, would not have much credibility.
Give us some insight into how the Fed works for people who are not familiar. If the chair has no credibility, but other governors, are data dependent, as you say, and they're dissenting all the time, does that ultimately affect policy, or is it still all about the chair?
Well, it could very well affect policy, but I think the Fed, it's still a committee that has to make a decision. It's not the Fed chair who imposes his or her views on the rest of the committee. And so it may be more than just dissension. It may be that the only dissenter is the Fed chair. Right now we have Stephen Moran, a governor that was appointed by Trump, who's pushing for a 150 basis points cut in the federal funds rate, and that's obviously makes him a lone dissenter. Now, imagine if he was Fed chair, he would just lose the vote.
And we're going to talk about the data that underpins that in just a moment. But I want to stick with this because you are experienced. You've worked at central banks. You've watched them. You advise on their actions for investors. Have you ever seen anything like this?
No, this is definitely right out there as something perverse and unusual and frankly unsettling. I mean, we've seen the other Fed chairs jump in and say, this is a political monstrosity and shouldn't be allowed. Look, I think there's going to be a tremendous amount of pushback. I think at the end of the day, this is going to be a disaster for Trump, at least in terms of pushing for whoever he wants, because the reality is the Senate may now dissent, may not agree with whoever Trump picks, given this blatant political onslaught.
As interesting as it is for me as a journalist to cover and for you as a Fed watcher to talk about, there's a difference between what makes headlines and what makes money. So for investors, how should we think about this development as it pertains to the long run outlook, even the call 1 year outlook for interest rates?
Well, let me give you something that I've learned over the years. I've been doing this for over 45 years. And one of the principles that I kind of abide by is that never let politics interfere in your investing decision-making. No matter what your politics are, the market tends to focus on earnings and valuation and kind of stick to it unless it's perceived that politics is going to have a tremendous impact on either one of those variables. I've also learned over the years to recognize that the U.S. economy and the stock market have done remarkably well despite Washington. This, as you said, this makes kind of all the headlines. And, the stock market initially on this headline about attacking the Fed Chair Jerome Powell directly, initially the market was down on it, and then it kind of firmed up a little bit. I mean, you can't make much from kind of minute by minute or hour by hour moves, but I think what's made the stock market resilient, his earnings have been resilient because the economy has been resilient. We haven't had a recession since the lockdown recession back in 2020, and that only lasted 2 months. Yeah. And that was an artificial recession. The last significant recession was actually in 2008, 2009. So the economy has been amazing, really, and especially this decade, which, by the way, I've been calling the roaring 2020s. And so far, so good. I mean, we had the pandemic, we had the lockdown. The lockdown was followed by a surge in demand for goods. That led to supply chain disruptions. That led to inflation. That led to the Fed tightening. And now we had tariffs last year. And the stock market's at an all-time record high.
I know, but what came after the 20s were the 1930s?
People always bring that up, and I try to calm them down by saying,
please.
Yes, that's true. The Great Depression, I think, and this can be somewhat controversial, but I think it was caused by the Smoot-Hawley tariff. In May of 1930 is when the Great Crash really started. The reality is the market actually rebounded from its September-October crash quite nicely through March, April of 1930. And then the Congress and the president enacted a horrible tariff. And if you think about it, we just went through all that, and we had a lot of tariffs imposed, and some people calculated it was as bad or as worse than Smoot-Hawley, and yet the economy, and indeed the global economy, you wouldn't know anything terrible happened.
And that's largely because a lot of that was walked back and not implemented. So a bit of a head fake there, but it does, I guess, introduce. It's interesting you say, investors, your North Star is earnings. Your North Star is not what's going on in politics. And again, I bring it back to this question of whether this time is different. We live in these unprecedented times. You have a president that more than ever, his hands are going deep into different areas of industry, telling executives what countries they should go into, telling different sectors what their executive compensation could look like, advising firms to go out and buy mortgage mortgage
Correct.
debt in unprecedented ways. So is this time different, or are you still sticking with that idea that earnings are your North Star?
Well, we still have a constitutional system of checks and balances, which I think is working great. Um, you know, Presidents don't get to do whatever they want to do, and maybe in some of these areas, signing executive orders work. But it seems as though every 4 years we change regimes and go from Democrats to Republicans, and the first thing that the new president does is cancel all the previous executive orders. So maybe all you'd have to do is kind of write out the current administration, and before you know it, it's kind of like the weather in some parts of the country. If you don't like the weather right now, just wait and it'll change. And that's what happens a lot in the political arena. But it's still a very check and balance system in our country. And so I think that will kind of moderate things. Look, the president just said that he would like to put a 10% cap on credit card interest rates. And the bankers have an enormously powerful lobby group that'll probably fight that fairly effectively. So a lot of these things are trial balloons, and they kind of go away before you know it. And yeah, look, again, it goes to the idea that we have some extraordinarily well-run companies in America. We have great workers in America, and we do well despite the politicians. We factor in what we have to factor in running our businesses that are the influences from Washington. But at the end of the day, companies have demonstrated they have this ability to, through thick and thin, generate earnings. The big risk is always a recession, and the economy is continuing to demonstrate its resilience. I guess it's going to get stress tested some more here with things like Venezuela, Iran. I mean, there's certainly risks here. To me, maybe one of the biggest risks that just emerges if we're going to have the Trump doctrine or the repeat of the Monroe Doctrine, isn't that going to embolden China to take Taiwan? I mean, that would clearly create a tremendous geopolitical, economic, and financial mess. So there are definitely risks out there, but the Chinese also recognize that there's some significant downsides in doing something like that. But all in all, unless you get something really crazy like that, I think the economy is going to continue to demonstrate its strength and deliver earnings. I mean, the earnings season right now for the fourth quarter, we're expecting earnings to be at an all-time record high, consistent with an all-time record high in the stock market.
And I think that's important to unpack. Geopolitics might make for better headlines, but at the end of the day, if profit growth is kind of all that matters, that really explains the bulk of the rally last year too, right? Earnings held intact, so it didn't really matter about tariffs and things like that. Give us a sense of your approach when it comes to geopolitics. Are you more inclined to be, I don't want to use the word dismissive of it because they're important in different ways, right, but are you dismissive of it?
Well, I'd put it a different way. What history has demonstrated is that geopolitical crises are great buying opportunities. You get some pretty intense sell-offs during the Cuban Missile Crisis, for example. A few months after Pearl Harbor, I think it was about 6 months after, don't quote me, it was several months after Pearl Harbor, the United States successfully destroyed a significant part of the Japanese Navy in Midway, and the stock market bottomed at that point. And there was still lots of World War II still ahead of us. So the market does offer these buying opportunities in geopolitical crises. Now, I'm not, clearly, if we go back to what you pointed out and say, well, what if the 2020s ends like the 1920s? Then you have a very prolonged bear market and a lot of pain. But that's not the scenario I'm looking for at this point. We had a significant bear market in 2022. Part of that was owing to Russia invading Ukraine, which contributed to the inflation, which caused the Fed to continue to raise interest rates. And that turned out to be a fabulous buying opportunity. We had the reciprocal tariffs, the so-called Liberation Day. and the market took a dive on that. And then, as you said, the administration backed off on it, and the stock market never looked back. I mean, it's just had this tremendous bull run.
And you expect the bull to continue. Your price target, 7,700 on the S&P 500, suggests some 10% upside from here. What's underpinning that? I assume you're going to say earnings, but I think we need to understand why earnings. Why are earnings so resilient?
Right. Well, in addition to expecting to get this to a new record high of 7,700 by the end of this year, as part of my roaring 2020s thesis, I think earnings won't be interrupted or disrupted by a recession between now and then. I think that the market, by the end of the decade, will be discounting $500 a share for the S&P 500. Put a 20 multiple on that, and you get 10,000. Earnings last year probably are coming in at something like $280 a share. This year they'll probably be about $310 a share. So yeah, I'm quite bullish on earnings because I'm bullish on the resilience of the U.S. economy. Now, the question of why are earnings resilient is the same question as why is the economy resilient? And I've been arguing for a while that the consumer may surprise everybody and continue to spend. And I'm a baby boomer, so I have a little bit of insight and maybe inside information. I'm not retiring. I really enjoy what I'm doing, but my friends are retiring. And, the baby boomers are the wealthiest generation ever to retire. They're retiring with $85 trillion of net worth. And so if you retire, guess what? You're not getting a paycheck anymore. So that actually depresses disposable income. And baby boomers make more because they're older, they're more experienced. So you're losing some pretty highly paid people who are retiring, but they've got these nest eggs and they're spending them. They're going on vacations. They're going out to eat. They're having a good time. They're seeing healthcare providers to make sure they're healthy enough to climb Mount Machu Picchu, and so they're spending. And in addition to all that, I think there's a lot of them providing financial help to the younger children. I mean, life isn't cheap these days. It's there is an affordability crisis. So I call it the Gen-shaped economy rather than the K-shaped economy. The K-shaped economy, most economists have been using that analogy to say, well, you got the rich are getting richer and the poor are getting poorer, and there are people who just can't afford to live paycheck to paycheck if that. And I don't dispute that. I mean, there's a lot of that going on, and clearly that is an issue. But I think it totally ignores the demography of the baby boomers retiring, and they're the ones that are really well off. Their kids, not so much, but there's a lot of support coming from the baby boomers to the younger generation, and so that would explain why consumer spending is so strong. We also have capital spending. More than 50% of capital spending is technology, and technology is something you really have to spend on to remain competitive through thick and thin. And finally, we've got this huge federal deficit situation, which you could certainly accentuate the negatives, but the positives of a negative deficit is it's very stimulative. I mean, we got $1 trillion of net interest outlays, and it's called outlays. It is stimulative because the government is providing $1 trillion in interest income to consumers or businesses, money managers that have these kind of securities.
So demographics supporting consumers, and I think that helps to explain some of the data dislocation that we've seen, like GDP is high, consumer spending is high, as you said, job growth doesn't look that good. So that helps to explain it. You're talking about monetary and fiscal stimulus, and I just want to back up. Did you say S&P 10,000?
S&P 10,000 by the end of 2029, by the end of the roaring 2020s. And that's only about 40% from here. It's not like, it can't be achieved.
And I think people will stop if they can throw a lot of arguments against particularly the US market, which is what we're talking about, it's valuation, it's a multiple, it's a historically expensive market, but there's two ways for a multiple to be resolved, right?
Yeah.
The price can come down or the earnings can go up, and it sounds like you're in the camp of the earnings go up.
Earnings go up and the valuation multiple can stay high. It's kind of little old me versus Goldman Sachs. Goldman Sachs has been making the argument that with valuation multiples historically high, returns over the next 10 years have to be low because there's no way valuation multiples are going to stay this high. But I've been pointing out that if you look at the history of the valuation multiples, they do tend to go down when investors fear a recession. But when it doesn't happen, you get a correction. So you get a 10 to 20% drop on fears of a recession. Then it doesn't happen, and the market rallies and resumes the bull market. The other alternative is they fear a recession, you get a recession, and that's the bear market case because then you get the PE going down and earnings going down. So the vitally important assumption here is what's going to happen to the economy? Are we going to have a recession? And by the way, if we do have a recession, it doesn't have to last very long, and it could turn out to be another buying opportunity. There's a lot of pessimists out there. There's a lot of pessimism out there. A lot of commentators who have basically kept people out of the stock market, for their own good, and it's been not for their own good at all. It's been terrible. They've missed huge opportunities here, and I think that if you look at it from my perspective, that the headlines from Washington are very depressing. Yes, we've got a huge amount of government debt. Yes, deficits are large. But when you put it all in the context of, well, what are the offsetting positives and, kind of have a balanced view, you come to the conclusion I have, which is we're in a bull market, and any sell-offs, even if it's a short-term bear market, are buying opportunities and not reasons to sell. The bears will get you out at the top. They'll get you out at the bottom. They'll keep you out all throughout the cycle. And that's a mistake.
I always, when I give presentations, I like to put up a long-term chart of the Dow. And
Correct.
I say, see if you can point out Black Monday on the chart. Still to this day, the worst single day you've ever seen in the market. And you can't see it. It's a blip. So time in the market, not timing it.
Correct.
Now, I know you spent a lot of time talking and thinking about the U.S. market, but I'd love your thoughts on just like the U.S. relative to the rest of the world, because even though you're bullish on the U.S., like even 10%, that's not as good as what it did this year, and certainly would be underperformance compared to what we've seen from other international markets. I'll put Canada in that basket. I'll put the German markets, the Spanish markets, Italian, Japanese markets, Chinese markets, all outperforming the U.S. over the past year, and some more than that. What does that tell you? Does it go back to, that the Trump issue might be more insidious than it is a day-to-day action?
Well, I think with regards to the tariffs, that's been another shock to the U.S. economy, to the global economy, and both economies have weathered that storm very, very well, again, demonstrating that not only is the U.S. economy resilient, but so is the global economy. I don't think we're deglobalizing. I think we're kind of rebalancing the globalization. But with regards to a more specific response to your question, I've been in the stay-home camp since 2010. Stay home means overweight the U.S., and recommending not to go global, not to overweight the rest of the world. And then it worked like a charm until last year. And then I had to kind of ask myself, well, is this just an opportunity to get more into the U.S., or am I missing something here? And I think what made me go global and suggest that, well, maybe now is the time to invest more globally. And I did that around the middle of the year, but not aggressively enough. But it's not too late, in my opinion. And I think the reason for going global is quite simply that there are huge and emerging middle classes around the world, particularly in emerging market economies. And people are aspirational. People want to prosper, and so there's tremendous middle classes that are growing much more rapidly than they are in the industrial economies in the Middle East, in India, in other parts of the world. And so I've been recommending overweighting the emerging markets. But the thing what really caught my eye is that stay home just worked all too well. I mean, the reality is the U.S. MSCI stock market now accounts for 75%. Let's do that again. Accounts for 65% of the market capitalization of the world. So it's increased significantly since 2010. And then I'm asking myself, am I actually telling people to overweight the United States where already it accounts for 65% of the world? I mean, it already is pretty overweight all by itself. I mean, if you just have a neutral stance, you're at 65%, which is a lot in the U.S. as opposed to other markets.
I think this flows nicely into areas you're finding opportunities. Let's get into some of your high conviction sector picks.
Yeah.
ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Ed, you made headlines when here you are, this long, staunch bull in a bull market where people love to throw, pessimism at it.
Yep.
And then you come out and you say, 2026, underweight the MAG7. Did that feel a little bit like blasphemy?
Not really. It feels kind of like watching Game of Thrones. For many years, there have been like 7 independent kingdoms surrounded by huge moats, and they all kind of left each other alone because they were all prospering in their own kind of relatively monopolized businesses. I think AI changed all that. Suddenly, they found themselves competing in the AI space and getting into each other's businesses, and as a result, there's a lot of competition. It's the AI arms race, if you want to call it that. And as a result of that competition, they are spending a tremendous amount of money on AI infrastructure without having a clue what the rate of return is going to be on that investment. I mean, imagine that they just build all these things and finish all these data center in the next year or two, and then NVIDIA says, "Oh, by the way, we have a chip that we can actually sell much more cheaply that doesn't require anywhere near as much energy. It doesn't need to be cooled," or somebody else comes up with that. And NVIDIA has to come up with that because if they don't, their competitors will. That's what competition does. And so suddenly it'd be a lot cheaper to build these data centers. Maybe we don't have to send them out into outer space, which is kind of the latest discussion of what we need to do with data centers. So it's the competition that's changed for me. And that means, look, you're always going to get eventually competition if you have a company that's got an amazing profit margin. Competitors are going to be attracted to that. Say, well, we want some of that, and we could do it better, faster, cheaper, and that eats the profit margin of those who are ahead of had been ahead of the situation. I'm also arguing that, hey, look, the Magnificent Seven, they are magnificent companies, but they're not going to stay magnificent unless all these services, products, hardware that they produce are sold to customers, like the S&P 493. These are the companies that are actually going to benefit, going to increase productivity from the tools provided by the Magnificent Seven. So all I'm saying is I think the market's actually broadening out. It's actually more bullish. I think it's not going to be limited to or concentrated in the Magnificent Seven. I think the 493 start to do better. The the small mid-cap stocks have done better, but I just don't see that their earnings are showing the kind of upward trajectory that I'm starting to see in the S&P 493.
All of the concerns that you mentioned were concerns that were percolating last year too. And so, yes, we did see a little bit of a slowdown in some of those stocks, not Google. But I guess my question is, like, why do you think this shows up in 2026? Is it because we're already seeing signs of exhaustion? And even if, like, the NVIDIA, say they can't charge as much, isn't that good for, Meta, Microsoft, Apple, Alphabet that actually have to use that, as long as the AI itself, takes off? And I'm asking because we just talked about how, bears can scare you out of the market. So, but it sounds like you don't feel like you're scaring people out of money-making opportunities by saying underweight this.
No, I'm just saying that you don't, right now the Magnificent Seven account for about 35% market cap of the S&P 500. I mean, that's very concentrated, certainly isn't diversified, and rightly so, because they have been outperforming. But I think semiconductors could do quite well without NVIDIA necessarily participating in that. I'm so basically what I've observed is that these companies, are actually getting into NVIDIA's business. I mean, for me, the big event was when Google suddenly came up with Gemini 3, and that outperformed OpenAI, and OpenAI has sort of been the epicenter of the AI revolution. And now Google's saying, "Well, wait a second, we can make chips. We have these TPUs, which in some functions do a lot better." Don't forget, or you'll recall, that there was a pretty significant correction in the Magnificent Seven in January of last year, on a dinky little Chinese company that came out of nowhere called DeepSeek.
Yeah.
And everybody started to say, holy smokes, maybe we don't need to spend all that money on data centers. Maybe we don't need to spend all that money on NVIDIA chips. And the Magnificent Seven came back during the first and second quarter earnings season and said, oh, no, we're still going to spend it. We still think we have to spend it. Sam Altman over at OpenAI says, we could cure cancer today if we had all the capacity that AI needs to do the job. So there's a lot of hype in that AI space. And I think right now what really has changed last year is now there's a lot of uncertainty. How much is too much in terms of capital spending? What kind of return are they really going to get? Are they sure that NVIDIA isn't going to, kind of blow up their investments in the current NVIDIA chips a year from now when NVIDIA comes out with better, cheaper, more energy efficient chips, or if not NVIDIA, AMD, or Gemini, or whoever, or a Chinese company. So that's the reason there's more uncertainty about the Magnificent Seven. I think there's less uncertainty that the 493 can definitely use these technologies to increase productivity. And oh, by the way, last year was an amazing year for productivity. Not so much in the first quarter, but second, third, and fourth quarters are awesome.
Do you attribute that to AI?
I do in some ways. I think a lot of jobs, rudimentary jobs probably aren't there anymore because of AI. But I would say that what AI has done is it's forced every company management, every business, all of us individually to look at how we do things and say, maybe we could do it more efficiently with AI. And so I wouldn't be surprised if a lot of companies look at it and said, not ready for prime time. But while we were looking, we found that this whole department is useless. So let's just get rid of them.
And I guess that supports your reason of like how things get better for the 493.
Correct. Yeah, the AI is sort of an eye opener. It kind of forces you to look at your entire organization and said, what part of this organization might actually benefit from that? And there will be benefits to it, and there'll be future benefits as AI gets better at what it's doing, fewer delusions, and gets the job done.
So your recommendation is, you're right. It's a huge part of the S&P 500. So just don't make it that big. Maybe in your portfolio, a teeny tiny part of the S&P 500 is materials, and even smaller is precious metals. But that's a sector that you would overweight. And of course, we got loads of that here in Canada.
Yeah. I would. I had been promoting the idea of overweighting technology and communication services. Put them both together; they're basically technology, and they account for 45% of the S&P 500. And again, like my thinking about stay home versus go global, I suddenly realized that hey, it's worked. And now, do I really want to recommend an overweight on two sectors of the 11 sectors in the S&P 500 that account for 45% of the S&P 500? And the answer is no, I don't. And so I would market weight those two sectors. I'm not underweighting them. Within technology and communication services, I'm underweighting the Magnificent Seven.
That's right.
Now, what do you do if you lighten up? It's basically rebalancing. If you have a portfolio and some stocks do amazingly well, maybe it's time to take some of the profits and move it into other areas. And I've been recommending overweighting financials, and I'm still doing that. They had a little sell-off on Trump talking about credit card debt interest caps, but I think they're going to do just fine. Industrials, this thing continue to do well from onshoring. And like you said, I mean, it's so easy to overweight energy and materials because you need a magnifying glass to see their market capitalization. But I've been recommending overweighting gold. I should have been recommending overweighting precious metals because it's the whole complex that's done well. But when gold rose above 2,000 in 2024, I said, I never had an opinion on gold because I'm a old-fashioned strategist. I need earnings. I need something I can value. But when it crossed above 2,000 in 2024, I said, this central bank idea that central bankers are buying more gold after Russia invaded Ukraine and we froze their foreign exchange reserves, maybe that's all you really have to know. So I said, I'm bullish on gold. But I got no way to tell you where it's going. Then it rose above 3,000 at the beginning of last year. And I looked at the chart and I said, hey, I can do this technically. I draw a little channel and that'll get us to probably 4,000 by the end of last year was my prediction. Well, we got above that, about 4,500. And then I had been predicting 5,000 for the end of this year. Now I'm using 6,000 simply because it's just moving so fast. And it's no longer just about central banks. I think there's a lot of other issues. I think a lot of Chinese investors who got destroyed in the property market and got whipsawed in the stock market, an asset that just goes up every single day, and every now and then gives you a day where it gives you a little bit of a buying opportunity. So the precious metals still look fine. Even some of the basic metals look fine. Oil is another kind of issue here. It looked like it was about to break down, and then there was a breakdown in Iran, and of course we had the Venezuela situation. I still think there's a lot of oil out there, and I'm not convinced that the downside is over for oil.
So market weight largely tech, overweight some of the more cyclical areas, financials, industrials, and those metals. I didn't hear in there, but I do know that you're overweight healthcare. And I think that's interesting because it's kind of been an orphaned, unloved sector. And why do you think 2026, it's got some great characteristics. If you like growth, there's growth. If you like dividends, it's dividends. If you like low valuation, it's low valuation. Why is this the year for healthcare?
Well, a lot of the market cap of healthcare is in pharmaceuticals, and the pharmaceuticals pipelines are drying up, and they're desperate to get new products, and so they're all looking at the biotech companies, and there's so many biotech startups and ventures out there that have cures for everything you're gonna imagine, and some of it, of course, is hype and isn't going to play out, but some of it is going to play out and can be leveraged up to have a positive impact on more people. So I think the pharma. I think we're just in the early stages of a great M&A boom in the healthcare industry, and I think that right now it's benefiting the biotechs. But then once these state-of-the-art biotechs get acquired by the big pharma and they leverage up those kind of new innovations, then the farmers do very well. So The big issue always is politics. There's a lot of controversy over Obamacare and subsidies and all that. But at the end of the day, as we said, it's PE times E, and the earnings outlook is looking quite good.
Before I let you go, Ed, I'd love to direct our listeners, our viewers, to where they can learn more about your research approach. As you said, 40 years in the market, there's so much that you can study and there's so much you could say, but I think the real value which you've offered is figure out what matters. There's a lot out there. We could all exhaust ourselves, but what matters for markets?
Well, you can go to Yardeni.com and there's two choices. One is the institutional research. So if you're an institutional money manager, that's probably going to work for you. It's more expensive. But we had a lot of requests over the years for a product good for individual investors. And it just seemed to me that there's a dearth in the market of analysis kind of relating the macroeconomic environment, the geopolitical environment, to the stock market, what's in the market, what's not in the market from a macro standpoint. And so that's what we do. And I think we're there aren't too many competitors doing that. And so that would be YardeniQuickTakes.com. It comes out almost daily.
All right. Love that. I'm going to subscribe to that myself. Ed, thank you so much for joining us on the podcast.
Absolutely.
That's Ed Yardeni joining us of Yardeni Research. Make sure you stay tuned to our next episode. We've got David Burrows on the show, a fund manager at Barometer Capital. He actually has a lot of the same ideas that Ed does, particularly when it comes to precious metals and financials. He's going to name some of his favorite stocks, so you won't want to miss that episode, and we'll catch you then.